We're at the top of the hour, and from our attendee list, we have a wide variety of geographic locations on this webinar today. So good afternoon all, and good morning, and aloha to those who may be joining us from Hawaii. Thank you for joining the latest installment in our Harvesting Value webinar series, where we'll talk today about the beef market and what we're seeing in a truly pivotal moment in time for the industry. My name is Brad Collins. I'm the head of protein and grain for our agribusiness lending team at American Ag Credit, and I will serve today as your moderator for the session. Before we dive into our presentation, I'd like to remind everyone of a few housekeeping items. You are welcome to submit questions for our speaker at any time during the presentation by using the Q&A feature on your Zoom taskbar. We will do our best to answer as many of the questions as we can at the end of Dave's presentation and follow up with those that we may not get to. Additionally, this presentation is being recorded, and we will share a link to the webinar with all of our attendees afterwards. If we have not yet had the pleasure of working together, American Ag Credit is a part of the Farm Credit System, an agricultural lender that supports America's farmers and ranchers with reliable credit. Our sole mission is to improve the lives of our fellow Americans by sustainably supporting agriculture so Americans have an access to nutritious, safe, and sufficient food supply. Our teams focus exclusively on agriculture, and like me, many of our employees own farms and ranches or grew up on a farm or ranch. From small to large operations, we understand the industry and how to structure loan solutions to help our customers achieve their goals, protect their legacies, and grow the industry's next generation. Our goal with this quarterly Harvesting Value series is to provide you with information and resources to help make important decisions for your operations. Our presenter today is my friend Dave Weber. Dave is Terrain's senior animal protein analyst. His career analyzing the animal and meat production business has spanned many sectors of the meat supply chain, from primary production, slaughter, and processing to the retail, grocery, and food service sectors. His career's work has been dedicated to the beef, pork, and poultry industries. Today, he'll provide you with insights covering the magnitude and timing of the herd rebuild, what current demand trends signal for the coming year, and how these forces may shape cattle markets over the next several years. Thank you for joining us today, Dave. I'll let you take it away.
Thanks, Brad. Thanks for that kind introduction, and welcome to today's webinar. The Harvesting Values seminar series is going to be an important bit of information for all those that participate. We're glad to have you on today. My role today really is to take us through some slides and some information really about what's going on in the cattle business and where we see things going from a herd standpoint, what we see in terms of cattle inventories, prices, consumer demand, and some forecasted information towards the end of our presentation to talk about maybe what we see for prices going through the balance of 2026. Jill, if we could move into our next slide. We've got our slides broken up today into three of those categories: herd rebuild, consumer demand for beef, and our price forecasts as we go. As we look at what's going on in the herd, really what we see is a herd in transition. This is coming from what we saw both in the cattle inventory report from USDA NASS that came out the end of January, and then some other work we've done independently as a group of farm credit associations came together to do a cow-calf survey across about 28 states, 10 farm credit associations, and about 1,050 customers that responded to those. When we look at the kind of high points of what we found in the survey data, herd expansions finally in plans. Jill, there you go. If you can go back there, there you go. Herd expansions finally in plans of more cow-calf producers, and we anticipate that they're going to continue to show kind of slow to modest growth. Expansion will not be a surge, and the leading factors holding back uh, producers today, grazing condition concerns, drought forecasts, pasture availability are top of mind. As we look at the breakout of what we saw in terms of survey data, we asked some demographic questions just to get an idea of kind of who we got responses from and what those operations look like. This is the age breakout. There are 10-year buckets as we went across there from 20-year-old producers to 70 plus. Average producer age about 57.7. These are the same breakouts that we found in the 2022 Census of Ag, the same buckets they've used for a long time. So we've got good representation of producers by age group. This mirrors what you see in the Census of Ag data. So we felt good about that. Our next slide shows us kind of how that group broke out in terms of size. So these are the numbers of females on these operations, the same breakout that Census of Ag uses. So we had some idea kind of what we were looking at in terms of distribution. We got a lot of similar responses really in that 20 head and bigger categories, 10 to 19, and orient you to the chart here. Blue bars are our survey, orange is Census of Ag. What we saw though is the 1 to 9 head group was underrepresented in our survey, which makes a lot of sense. There's not a lot of folks that come to Farm Credit to borrow money for an operation of 1 to 9 head. Those are either out of cash or credit card kind of things, we think. But when you look at it from a Census of Ag standpoint, they account for a full third of cow-calf operations. So when you include that, it kind of skews their head count to the small side. The last survey from the Census of Ag had average herd size at 47 head. We're a full 100 head bigger in our survey. So we've got more of the operations that are trying to make a profit out of it. They're responding to economic signals and felt good about that from a distribution standpoint. When we look at what's coming at us, the survey asked several questions in terms of what did you do in 2025? What are you going to plan to do in 2026 and 2027? And when we look at the data looking forward, about 43.5% of producers anticipate that they'll breed more females in 2026 than 2027. About 30% said they would not, and 26% were unsure. So there's some folks that are trying to figure out where they're at in terms of what's going on for the cycle. So we'll see some of those things happen this spring. They would be probably, if they're spring calvers, working on those decisions today. And then if we look at what they plan to do in 2027, we see a smaller percentage of producers that are certain about growing and a smaller percentage of producers that are planning not to grow. So we just saw that growth really in that unsure category. When we look at what happened in terms of producers that reported their changes for 2025, we saw that about half of the producers increased their numbers in 2025, and half plus one actually did not increase their numbers. So they stayed the same as we went through 2025. When we break out the producers that grew, what we saw was about 65% or so of producers used cows to grow their inventory during 2025 and breed more females during 2025, and about a little more than about 25 to 28%, depending on what region we're looking at, used heifers in the mix. Total growth on the operations that did grow during 2025 was about 13%. When we net that all back, it lined up fairly close with the USDA inventory report. And our expectation going into that report that there might be 1.5% or so growth. USDA came in and said actually the cow herd shrank, and part of that was driven by their revisions to the 2025 inventory report. When we look at why producers have decided not to grow, when we look at our next slide here, we asked producers really give us a ranking of these 7 items. We went through a list, a much bigger list, but boiled it down to these 7 important reasons that a producer might not have grown during 2025. Um, a full third of producers ranked grazing condition concerns as their number one reason they didn't grow. And on average, amongst all producers, it ranked number one. The drought forecast was of concern, ranked number two. It was a solid number two in the rankings. And then pasture availability ranked number three, which, as we think about it, probably makes a lot of sense. If you've got concern about the current ranch grazing conditions, maybe we went through the drought, excuse me, during the past 4 or 5 years. Maybe we didn't get cattle off of the ranch. It hasn't had time to recover and recuperate, those kind of things. Or we look at the ranch today and say, hey, we're part of the West that's under drought conditions today. The forecast is that may continue. What do we do? If we've already got the cows on the ranch, we either have to depopulate or find more pasture availability. And that came in number three, with about a quarter of operations ranking it as number one. When we look at price impacts, price landed in the middle of the pack. About 16% of producers ranked price as their number one concern for not increasing herd size. We didn't restrict that to their interpretation of price. I had a longer list that we whittled down. One was, hey, replacement females, either heifer calves all the way to aged cows, were too high priced, or calf prices were too low. Really, that's the same pricing problem, right? When we look at producers' view of that, we just said, let's leave it at price, and they can define it on their own. So it landed in the middle. Labor availability was a smaller concern, came in number five. Age of producer that we saw was close to the average age of farmers in the United States was number six. We see that there's some concern and there's some activity going on in terms of generational turnover, those kind of things. And then number seven, we asked another adjoining question to this. Number seven was political and tariff uncertainty. It ranked generally in the bottom half for most producers, but we'd asked a separate question. The impetus of the survey was during the October government shutdown. We were concerned USDA wouldn't get the surveys out and collected in time to get that data turned around for the January inventory report. And so we were like, let's figure out if there's something else we can do. In the middle of that, you all recall, we heard from the president that his viewpoint was beef prices, particularly ground beef prices, were too high, and that there would be some changes in import tariffs, tariff rate quotas, some of those kind of things. Some of that's still going on. Part of it was with Argentina, but the bigger piece was what happened with Brazil. And we asked separately producers, did that change your opinion and your plans for growth going forward? And about 22% said yes. When we look at that whole broad viewpoint, it just really tells us that there's a lot of uncertainty in producers' mindset, either price, pasture availability, those kind of things that are holding a lot of producers back. And some of those things we don't see changing going forward here. So we've got a forecast of fairly modest to slow growth as we turn the herd around and start to grow. Part of it is, and we see it from a customer standpoint, a lot of work fixing balance sheets. We may have spent a lot of money on hay. We might have had some forced liquidation of some cows that we had to buy back. Those kind of things. Interest rates are clearly a concern. When we look at the cost of females today, we've doubled the price of cows and we've doubled the interest rate, which when you do that, now we've got a 4x interest bill that we've got to cover out of these cows across the herd. So there's a lot of headwinds there that maybe have people holding back just a minute until they're in a better borrowing position. When we look at our next slide, Jill, here, let's transition into thinking about what we saw in the inventory report and maybe do a little comparison and contrast here as we work through what we got from the USDA official data. Certainly, they're a lot bigger survey, would be including a lot more of those smaller 20 head and less operations, and we'll see how those kind of things shake out. This chart is the beef cow inventory data that came out for the January 1st number, slightly smaller, down about 1% on beef cows as we went into the beginning of the year. Close to a bottom, I think, as we look at that going forward. But there's some concerns as we move forward here. As we look at our next slide, it's a quick look at beef replacement heifers. And we've got a bigger number of beef replacement heifers in the data from USDA, about a 2% increase in beef replacement heifers. The challenge with that is that the number of heifers expected to calve this year still outnumbers the number of beef replacement heifer calves that we plan to breed this year. So that's a headwind for a really rapid or expanded growth as we go forward. And there's a lot of reasons, I think, why. If we look the last 2 or 3 years, we've been in a pattern of saying we're going to keep beef replacement heifers, and then actually once we get past the first of the year, looking at how much monetary profit opportunity there is in those females by sending them into a grazing program and then onto the feed yard. And I think we're at some risk of having that happen again this year. When we look at our next slide, it's a quick look, maybe a different way to look at what's going on in the beef replacement heifer dynamics. This is beef replacement heifers in total as a percent of beef cows. And you can see as we're working lower, we need to get down in here to a bottom before we can start moving this number higher. Clearly, we need to add 5 or 6% more heifers as a percent of beef cows before we can get into some kind of expansion. So we've got to get that ship turned a bit as we go here. So really more of those headwinds in terms of growing numbers. We've got to put more heifers in the system than the cows that we slaughter out of it. Our next chart here looks at what's going on from a beef demand standpoint. And as we transition our thinking here, let's set aside what we're seeing in the inventory, tight numbers. When we look at the expansion side, we're going to have to reduce beef production before we can grow it. That transition of heifers out of the beef supply chain into the cow herds is going to be the change. And as we do that, and we think about the supply demand price relationship, there will be a supply response to price, or a price response to supply. As we tighten those supplies, we're going to do that as we go. We've been doing that the last several years and haven't seen big changes. We've been kind of treading water from a beef production standpoint, and we've done all that change with weight. With bigger carcass weights, we're able to offset part of the headcount challenge we've got in terms of the numbers that are declining. But once we start herd expansion in earnest, there's going to be a jump there. And then we add that to what we've seen in terms of beef demand. This is the All Fresh Retail Beef Price Demand Index, one that we've seen in the industry since really going back into the early 2000s, late 1990s. This is the same math that Wayne Purcell developed at Virginia Tech that we've used for a long time to gauge where demand is. You can see here the last data point on the right is November, and it is a record high. The biggest in this data set, if we go back to what we've got from other viewpoints of demand, probably the biggest demand that we've seen from a consumer standpoint till the mid to early 1970s. So great recovery here. If we look at this, I like this chart because it spans my entire career, and we've seen some pretty significant changes. And if we look back into the 2014, 2015 timeframe, we saw a big jump there. We saw a reset on valuations during that 2014 year. We were in tight supplies on all proteins and saw a new step up in terms of price. We've got a chance of going through some of that again here over the next couple of years as we tighten supplies, particularly on the beef side, and then continue to see the U.S. export significant quantities of pork and poultry, limiting domestic supplies. What we've done, looking at the index over time, is decided that it's kind of a complex, maybe abstract way to view demand. And so if we look at our next slide, we've got a different way that we've gone about trying to measure demand and make it a more consumable, palatable viewpoint in terms of getting folks to understand really where we're at. And what we've done is we've created a data set that's real per capita expenditures. So when you hear an economist like me talk about real, those are deflated dollars. So we get rid of the inflation impact on prices, and the CPI is adjusted out of this. So these are 2014 dollars. So we go back to the last cycle high, and you'll see in this chart these are the monthly spending numbers for beef using the all fresh retail beef price. Been a pretty solid year, really kind of stagnant as we went through 2025 on a monthly basis, spending about $36 per capita, really from March into August. And then we saw prices start to march higher as we saw retail prices move and beef production numbers exceed expectations through the late third and early fourth quarter. As we look at November there, certainly a jump and a change that we saw. Not what we hear necessarily in the trade press. The trade press sometimes gets some of these things from a different viewpoint, that prices are too high. Obviously, as we went through October, the president had that viewpoint. But as we looked at November, the reduction in exports that we saw and the big growth in imports that we saw for the month added to domestic supplies. At the same time, prices were going up. So that's where we got this jump to a new monthly record high in terms of monthly spending there in November. I expect that as we get the trade data for December, we're probably going to be in that $39 to $40 territory again, which is part of the normal seasonal decline for beef as consumers move out of the beef sector a little bit. We get some more turkey spending, some of that kind of stuff. Leg of lamb, those kind of holiday dishes take a little bit out of the beef spending share, but still in very solid territory. If we look at our next slide, we can take a view at how this looks from an annual standpoint. So these are per capita spending numbers over time for all those months added together. So we anticipate record high. At this point, I don't think you could wreck December bad enough to make the data say that we didn't grow substantially for the year. We're probably going to see somewhere on the order of $25 or $30 per capita more spending. So that's $30 of 2014 dollars for 330 some million Americans. So it's a huge increase in the volume of dollars moving through our system, which as we work through the margin businesses of packers, feed yards, and stocker operators, and that rolls back to the cow-calf producer, he's getting the brunt of the bulk of the increase here as we look at 2025 and going into 2026. Our next chart looks at this on a nominal basis, so not deflated. So we haven't accounted for all the CPI changes over time, and it's an impressive run. I put it in there just for a little bit of the shock and awe value. When you go back and look at this, we're going to just scare near $600 spending on a nominal basis per capita, and you don't have to go back very far, 2012, 2013, to see that back then we were spending $300. So doubling of spending per capita has been tremendous for our business. So let's set that aside for a second and let's talk about some other demand measures that we see that maybe give us some hope that we can continue this trend as we go into 2026. We've got a couple of charts here that are scatter charts. If you're an economist, you've got a tendency to use these because they provide us a good timeline and history of how this relationship has changed over time. The far right and highest data point here is 2025. And what the chart's trying to show us is the relationship of all fresh beef price to average hourly wage. And these are all the December's data over time. So we're only looking at the month of December, and we want to see how that fits. From a statistical standpoint, that R squared number is a measure of fitness, or how good does this model fit the data. Explains about 94% of the change, whichever direction you want to go. All fresh price changes reflect about 94% of the change in hourly wage. So we're not really that far out of line. If we stretch the relationship, yeah, we're to the top end of it. But if we look at this historically, we can stay in this above the line area for many months before there's a correction. If we look at our next chart here, a similar viewpoint, but different data set here. This is all fresh retail beef price compared to pork. What it says is, yes, we're relatively high priced to pork. We continue to be that. One of my arguments to the president's commentary was, if beef prices are too high, consumers have options. Pork and poultry have not been able to capitalize on the big gap in pricing that's been created between beef and those two other proteins. Have they suffered from it? Not necessarily, but they haven't been able to narrow the gap appreciably either. And this chart would just kind of reflect that we're kind of on the outer bounds of that relationship. Our next chart shows a similar picture for what's going on with chicken. Maybe not as dramatic as what's happened with pork, but certainly not out of the realm of possibilities from a historical standpoint. We don't see consumers, trading out of beef particularly, but there are cheaper options out there. They choose to spend their money on beef because they value the quality of the product and the eating experience. When we look at our next slide here, we're going to move into kind of what all this means in terms of where we think prices could go. If we look at the next slide here, this is our forecast, our current forecast of 400 to 500 pound steers, basis Oklahoma City. We've started the year at very impressive prices for those calves, somewhere in the mid 540, 550 kind of territory. We've moved higher over the last couple of weeks. We continue to see feeding and stocker operations trying to accumulate cattle with the intent that prices are probably going higher and they want to own some cattle earlier. The grazing prospects vary, and as we look at weather forecasts, the drought is likely moving to other parts of the country. So we've seen some concern there, or some places that might be dry today that folks are hoping to get some more moisture from, and start to see prices continue to really tread water kind of in these high $5 territory. No doubt there's cattle further north that are trading $6 a pound or higher for the 4.5 weights. We've seen a few of those. Those cattle are going to need a lot of days and a lot of grass before we can make them even come close to breaking even on the live cattle futures when they come out of the feed yard. But as we look at our next chart here, here's the CME feeder index, kind of that interim step for these cattle, outperforming our forecast here really since the beginning of the year. Prices, I think last week's feeder index average was 374. As we look at prices going forward here, we're probably seeing some price resistance as we go past the 370s, really just because of that negative view and buying negative break evens that result in negative margins. Potentially, as we work through the year, we see the tightening of cattle. If we do any kind of expansion activity, we're going to take those females out of the mix and tighten supplies and see probably prices move closer to the $4 territory as we get to the back half of the year. When we look at our next question, or our next slide here, this is Nebraska fed steers, tracking right along forecasts here so far this year. Prices in the 240s, 245, trading in the south last week. We didn't get that far in the north, but working our way through February here as we kind of just tread water from a demand standpoint. Once we get past Valentine's Day here on Saturday, we'll see a little bit of I won't call it a doldrums, but a kind of a transition as stores get reset and start to prepare for grilling season. We got to get past St. Patrick's Day. We'll see some demand for briskets over the next month, but the rest of the cutouts probably trading more sideways until we get into grilling season. And once we do that, we see a pretty good run in fed cattle prices and values, probably into the low 260s somewhere. That sounds great, but that for a lot of cattle is just break even. So we'll see those probably move. The challenge we've got is we're probably stacking two contra-seasonal years on top of each other. We were contra-seasonal in our price pattern last year. We see that largely again this year, and it's partly a function of changing the seasonality. With the extra days and extra weight we're putting on cattle, where we used to see the tail end of the feeder cattle supplies that were placed in say the summer cattle from last year, August, September, going into October, and then the calf-fed cattle, starting to stack up on top of them as we look at marketings for the end of May through really the 4th of July, where those two populations stacked up and added to big supplies. We've spread that out, and we're pushing those cattle further back into the summer. And so it leaves a gap for meeting that grilling demand supply and supply requirement during that May and early June timeframe. When we look at our next chart here, we're going to do a little bit of transition into the question and answer section. The one thing I would add as a slide here to finish on, Jill, you can go back to that the slide of heifers as a percent of on feed. It's one to kind of talk about here and transition into questions as Brad comes to join me for the Q&A section. One of the things we do monitor as a part of the on feed population is the percent of heifers versus the total. The red kind of pinkish band, however it comes across on your screen, mine's getting kind of orange today. That band is kind of where we view herd stability. It takes about 36% or less really to get into the expansion territory. And we can see as we go through into January here, we grew heifers as a percent of on feed versus a year ago. And that challenge continues as we continue to find value in these females going through the supply chain, the beef supply chain versus staying in the herds. So with that, Brad, do we have any questions we can answer?
Oh yeah, we've had quite an active Q&A entry here, which is wonderful. Thank you so much, Dave. I mean, there's a lot of information. We're at just a whole different level. You talk to people around the country, and it's like, man, we've never been here before, right? Like what do we do now, right? So I'm going to jump into a few questions here, and I think a lot of this you covered. So if a question comes out on what you covered, I think we're wanting to dive a little deeper here from what I'm seeing on questions. But one of the questions are, Dave, what are the impacts of high cattle and beef prices on trade and domestic beef availability?
So what we've seen is and this will be a little bit of an axiom of economists. And as we look at it, one of the things that's happening is high prices are trying to cure high prices. So when we dig deeper into that, what should high prices in the U.S. do? Well, they should probably limit exports because our products are becoming more expensive on the world stage. We still have some very dedicated partners in Japan and Korea and some other countries that really prefer and we're the only supply of some of the high quality grain-fed, really high grading kind of product that they prefer. So we're still exporting, but not at the pace we were. If countries are looking for more modestly marbled or lower marbled kind of product to go into their diets, they're having a little bit of price shock on U.S. product, and they've probably moved to Australia or Brazil or Mexico for some of that product. On the flip side, our high prices and the spread between domestic, say 90 lean trim in particular, versus international prices for 90 lean trim is attracting a large portion of that world supply into the U.S. We're going to have about 2 billion pounds more product imported this year than we had exported. So it's trying to balance that supply and demand picture. Prices are the magnet that are going to do some of that. I don't think we should be surprised that we'll probably continue to see fairly large imports despite the tariff situations. We've moved those around a lot during the year. Brazil in particular went from paying 26.5% at the beginning of 2025 to paying 76.5% punitive tariffs for kind of the middle 6 months of the year. And then the president, once he figured out how much that shut off supplies, attributed a lot of the rally in beef prices to that switch, turned around and took the punitive 50% tariff off. And then we saw, those volumes start to increase. Brazil still does not have their own tariff rate quota. So they spent the first 3 days of the year importing product at uh, less than 10% tariff, triggered the quota, and now they're paying 26.5% and shipping fairly large volumes.
Yeah, thanks, Dave. Thanks, Dave. I think it segues into kind of the next question, which has been popular. So, after the president's comment about ground beef prices being way too high and we've got to do something about it, and I know you spoke a lot and you have some good slides on where beef consumption's at and stuff in your presentation, but what do retail prices and spending look like for competing meats?
So that's an interesting viewpoint, and part of the thing I think the administration missed is that when you look at those spreads, yeah, they're wide. Beef is high priced, but it takes pork and poultry, lamb and turkey spending combined to equal beef spending. The U.S. consumer absolutely prefers our product, and the price spread says that, right? You can go to any grocery store you want to go to, and you can find cheaper protein than ground beef today. They have a choice of doing something else and they're choosing not to. That's not our fault. And that's why I think a lot of producers felt like they kind of got stabbed in the back a little bit, and or kicked in the backside, because we didn't make that decision. The consumer made that decision. On the flip side, then sometimes we hear, hey, these imports are huge. They are. They're trying to meet consumer demand. But they're not all negative, because if we think about the breakout of carcasses and all the extra carcass weight we've got, there's a huge pile of that is 50% lean trim. That if we don't have some kind of lean trimmings, either from a domestic standpoint, which we're in tight supplies on beef and dairy cow slaughter, if we don't have that product to blend, then 50s aren't worth $1.40 a pound. They're probably worth 40 cents a pound. And we've seen that swing back and forth over time. When we get in tight cow slaughter numbers, if you don't have some kind of import product, you're going to be languishing on 50 lean trim value. And it's not small. It's at least 17% of carcass value is 50 lean trim. So we're talking $150 a head swing in value just with that import trim product. So if we want to say no to imports, we got to say no to high 50 lean trim prices at the same time. So I'll let folks make that choice on their own. It's a challenge for the industry with all the extra days we're putting in cattle today.
Yeah, it's quite a balancing act right now, for sure.
It is, definitely.
Yeah. One more kind of big picture question here that's coming up, and we've heard it in the past, but I think people are wanting to get your take on, let's go to the Mexican border, right? We're currently closed. Are we going to open? Yes, no. When? We don't know. But what effect, if any, does the border situation lend to the expansion of the herd or any of these other big picture items?
So if we look at, let's not have the whole history lesson, but the important piece of the history lesson, right? For 2025, we missed out on about 1 million head of imported feeder cattle and calves coming into the U.S. because of the border closure. So if we look at the change in the on-feed population, those cattle would have gone through, most of them through some grazing program, and then ended up in feed yards, really from Southwest Kansas south, most of them in Texas, a lot of them in South Texas. So if we look at the Texas cattle on feed number in particular, almost all of the decline there is because of the border closure. So that's been a tough situation for those yards, because moving further north adds freight and basis and probably higher quality cattle to their cost structure, on top of higher corn prices the further south you go, right? So that's been a bit of a challenge. When we look forward and say, all right, how many could be left and what time frame might the border open, we continue to see very active work by USDA and their Mexican counterparts on the sterile fly production and deploying those flies in the important places where we're trying to prevent the spread further north. It seems to be working, but it's close, right? We're not that far from the border from the closest cases that have occurred. In the meantime, while all that's going on, the Mexican cattle and beef system has absorbed essentially all that million head, slaughtered them, a lot of them at light weights, at huge packer margins, and then exported the bulk of that product, probably to China, other Asian countries, some to the U.S. We had some big movements of Mexican product to the U.S. in the late part of the year of 2025. So we're getting some of that product as beef instead of cattle. That's a challenge because it affects utilization rate of feed yard capacity and packing capacity. No doubt it's part of the change that we saw in the Amarillo Tyson plant slaughter schedule going back to one shift. It's because cattle availability is tight in Texas. It's not a lot better in Colorado. And so we're starting to see that challenge move further north. Timing wise, your guess is as good as mine. I don't see it in the first half of the year, and I'd give you slim odds that it's in the second half. There's enough risk there that I don't see us changing. Does it add fuel to the fire domestically in terms of the need for herd expansion? Absolutely. But we're just not seeing any response there. So we're going to go through these tight cattle supplies. If it did open, there's a lot of debate around how much it could be. The longer it goes, the smaller that number is. Mexico's shut off their southern border, so they're not importing cattle. Their old mode of business was taking those northern high quality genetic cattle that really, a lot of them indistinguishable from the southern half of the U.S. kind of cattle, moving those either across the border and feeding those cattle in the U.S. And becoming part of our beef supply, or they would take some of the best end of those and feed them there domestically using U.S. corn in the northern feed yards and plants, and then exporting the beef to us. When they shut off the southern border, they had to transition those cattle into domestic consumption. So they went to super short day feeding periods, and then the margin was such the plants just ran as hard as they could to get them all slaughtered.
Yeah. No, thanks, Dave. Let's kind of bring this a little bit closer to the ranch here now, right? So really good question with this historically high prices. The question is, what price should I use for 5-weight calves for long-term projections at the bottom of this cycle?
That's a great question. And to our attendee that submitted that question, I applaud you because it tells me a couple things. We've got producers today that are saying, yeah, maybe 2025 and 2026 aren't 2014 and 2015, which I don't think they are. We're probably still in the up part of the cycle where 2015 was where we saw things turn over. But we've got our futures, our vision set on understanding the business. Hey, there's going to be a day and time when this thing rolls over. And like, as I go through that and you look back historically through, cattle producer records, ranch records, some of the financial analysis programs that are out there through extension, what you typically see is prices go up, so do expenses. And this producer in particular is wanting to know, what I hear in the question is, what does my calf break even need to look like
Exactly.
at the bottom of the cycle? Like,
Yep.
Let's not manage for the top of the cycle. Let's manage for the bottom of the cycle. I think the number probably needs to be probably back close to the cycle highs from 14-15. So if we look back at those 4-weight or 5-weight steer calves, 2014, 2015, average somewhere between 240 and 260. $1,100 a head production cost would be a good target. The other thing that helps us do as we get that viewpoint, if we take this year's prices as the highs and do a net present value calculation for the value of a female, either as a young bred cow or a beef replacement heifer, that shape of that curve is important because it gives you the value of or the profitability under the curve minus, price minus cost. That gap over time helps us predict what cow prices should be or what producers could afford to pay for them. So your banker's gonna be really happy with this question when you go to him and sit and say, "Hey, this is where I'm trying to manage my business. Um, let's figure out how to grow and maximize the opportunity of the grass we've got on this ranch, and do it in a way that is mindful of the future."
That's good. Um, Still back down at the at ranch here. I mean, we've just been at unprecedented high prices, and so this question, and I'll just read it verbatim: will the tax credit for heifer retention really affect the expansion for the small guys that have the cash flow of $4,500 red cow?
Yeah. So, we got to get it funded first, which Congress hasn't done. But even if they did, I'm not sure it gets the response that maybe some in government think it could get. Um, does it help? Sure, it doesn't hurt. But when you look at those smaller producers, it may not be enough to get them over the risk hump of what that takes. And it certainly depends on their balance sheet. The other thing is those small producers, they're not in this business as a full-time, like it's all the revenue and income for a family. There's probably off farm income that's subsidizing that. So it not that it's a loaded question, but there's a lot of variables that go into that besides. And then you've got really how much of that tax credit offsets the extra interest cost. And it would take a lot.
Yeah, no doubt. I think, yeah, this is really good discussion, and it's something that all our attendees, as you work with your lenders, we've got to be open and honest about where we're at and the efficiency that we're deploying financially and everything else with production on the farm and ranch. So, Dave, here's a good one. Uh, Outlook on upcoming summer run for yearling prices.
Oh, so that's a good one. We had that chart on yearling prices. I think we might have got through that. Um, high, like high. But with that becomes high risk of that not becoming a realized outcome. So as we look at the spring market, as we work through, and I apologize, I'm looking over here at my futures quotes. The board as we go out through, well, from May to August, so summer months and early summer months when we'd be looking at that gap of the grazing season. Those cattle right now trading 360 on the futures. Today's CME feeder index 374. I think the feeder index is probably closer to right. So what do you do with that, right? I think that's probably some of the risk and some of the challenge in risk protecting some of those cattle. Um, Understand oh, perfect. Thanks for putting that up, Joe. As we look at that forecast out of our models and our experience here, as we look at those August and early September numbers, probably somewhere over $4. That makes risk managing some of these a little bit challenging, depending on the size of your operation. I'm in the world that risk management isn't all or nothing. Figure out what your absolute bottom line number is in terms of revenue that you need to keep the lights on and make this thing, pay back the price you paid for the calf to start with. Family living expenses, the things you put into those animals, and start just creating layers of like, I need this much protection in LRP or straight into the options or the futures, and start working your way in there. Do you have to hedge them all at once? No. But figure out how to live another day if something bad happens. We'll talk about black swans a little bit. What are the black swans out there? Well, let's talk about what they're not. Packing capacity changes. There's probably more closures on the way. that's going to be an impact. That I wouldn't put that in the black swan category. That's a risk factor we need to protect against. That means feeder cattle and calf demand could get smaller somewhere in the future. Is it near term? No. Just like we saw in Lexington and Amarillo, reductions in hours and closure. Did it change the market today? No. Will it? Someday, yes. Just like Plainview did back in um, when Cargill decided to close it. We actually slaughtered more cattle after it closed than we did before, and there's financial reasons for that. When we look at the Mexican border, I don't think we can put that in the black swan category. We've got a lot of analysis around that. It shouldn't be a surprise. The date might be, the timing might be, but we can't say that one caught us by surprise because there's enough information around it. So I would encourage folks, A, know your cost of production, and B, figure out some way to protect the margin you've got made, because there's going to be some of these summer feeder cattle that make a pile of money.
So I've got some a little bit specific question here, but it's surrounding weather and it's surrounding drought, Dave. It's really focused on the Colorado River Basin, but also the Southwest and the impacts that we're seeing that could happen with continued drought conditions. We're at historically low snowpack for the Colorado Rockies. Those of us, I'm a Colorado native, so it's like haven't seen this before, and it's going to be a little bit tough. But with regard to summer grazing and the previous question, the upcoming summer run of those yearlings coming off grass might be a little early. What are your comments there?
Yeah, no, I think that's a real challenge. And you and I live fairly close to the same neighborhood, and I've covered a lot of Colorado in the last month, either trying to some decent snow to ski on or doing some producer meetings. There's a lot of bare dirt across the Continental Divide, and when we look at that in terms of effects, east slope, west slope. The West Slope side, I would say that's really a Colorado River drainage issue. It's going to affect everybody downstream as well. So when you add those all together, Colorado, Utah, Arizona, and those cow herds and how that changes, probably pretty dramatic impacts for those producers. We've started seeing some of those in the last 6-8 months anyway. If you look at kind of that Walden, Craig, Hayden, all the way into the Grand Junction kind of territory. Been dry over there, really since last summer. Big impacts for them, but in terms of the whole cattle industry, not big. There's only about 3.3% of the cow herd that lives in those 3 states. If we throw New Mexico and call it kind of a Southwest issue, then we're still less than 5%. So I don't think we're big enough to move things around very much, but certainly it changes the seasonality of some of those local markets, and we're gonna have to plan around that. Don't let your risk management plan dictate your marketing plan, especially when you've got these kind of conditions coming. That would be a caution I would put out for folks. Have some flexibility and proceed with caution.
Yeah, no, good advice, Dave. We're getting close to time here, so I'm gonna pick
Let's do a couple rapid fire ones. And
well, yeah, there's way too many rapid fire ones. I can't compute in this short time period. But what we haven't talked about, and this question verbatim is, how much will the new dairy buyout affect the beef feeder market? And I think I'm going to have you expand a little bit, just the beef on dairy phenomenon and what effect or what we've discussed on that front.
Awesome. So the proposed or talked about proposed dairy buyout. Last one we had was 1985-86. It got approved in 85. Actually happened in 86. The big impact there was on cull cow values. Like it happened right in the middle of when we were trying to market some cull cows off spring calving herds. Dairy guys got a black eye over it. Did it need to happen? Probably we were way overproducing, much to a much greater degree than we do today. But the dairy marketing system was different then. We still had quotas and those kind of things within dairy co-ops that we largely don't have today. So it would take an act of Congress, and we can see how ineffective they've been, not just in the last 12 months or this administration. I don't know that we get a farm bill put together that would address this. We're probably in the kick the can mode again on the farm bill, and largely the big beautiful bill is going to propagate some of that, because some of the things we needed to get taken care of, and some of the emergency funding for especially row crop kind of production, we've gotten taken care of in big beautiful bill, and some other authorizations that make a farm bill probably further away, not closer. So I don't think it's a high odds kind of question, but we'll answer it anyway. Does it impact feeder cattle and calf prices? Absolutely. In the near term, probably has an impact on ground beef availability, because that's where those cows are going to go. But that's probably the only negative there is, because if we take 1 million cows out of the cow herd, we take 600,000 beef on dairies out of the feeding stream. That makes feeding margins probably tighter, because we go compete, amongst feed yards for feeder cattle and calves. We drive up prices, margins probably get hit a little bit. For cow calf and stocker operators that are not part of that system, probably a benefit. So it's not all negative that would cause. I think the other thing to think about when you talk about the impacts of beef on dairy, certainly high quality, very acceptable to consumers kind of product. But at the same time, when you think about what those calves do to dairy revenues, they account for they add about $5 a hundredweight to milk prices. So when you go look at the futures and you see, I didn't even look today what they are. We're probably in the $15 to $17 a hundredweight kind of territory. For a safe number, go add $4 a hundred to that. In the old days, sub $17 milk was dairy farmers losing money. We're not there today for a lot of them, and especially with feed prices becoming more manageable.
Dave, thank you so much. We're not going to get through all of the questions here. So for our audience here, we will definitely get those down, and we'll get some answers that our crew will send out to you. Again, this has been recorded, so that we will get you a link for that as well. I really do. We all just really appreciate the questions. They were thoughtful. We're going to have more of these, so stay tuned. I think the crew will drop Dave's contact information there in the chat. And then again, you can go to terrainag.com, look at our other industries, and follow up on our insights there, as well as americanagcredit.com. Look at our lending programs and what we have to hopefully make everybody continue to grow in this exciting industry. It's exciting times. But with that, this will conclude our webinar. And thank you again for joining, and just have a very great rest of your day. Thank you all.